Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So today's Friday night, and you know what I was thinking about? Maybe we need to create a velocity banking nightclub. So we have a loud music, we got bouncers, we got drinks. In order to come in to the club, you got to have your laptop, spreadsheet, and a line of credit, and the bouncer's going to check all that. And also, no weapons, right? so, and also, I'll charge you a $10,000 entrance fee. No, I'm just kidding. I'm not going to do that. But let's just pretend that this is a Velocity Banking Friday nightclub, right? So it's Friday night. I don't know what you're doing, but hey, if you're focused on paying off debt and learning how to pay off debt, that's pretty awesome, right? So that's why we're all here. And so what we're going to do is just do the same thing that we always do, which is use velocity banking. And if you don't know what it is, all this is a strategy to easily pay off your debts using a tool called a line of credit. So what's a line of credit? All it is a financial tool where you can borrow money, pay it back, and use it over and over again, right? So there's various types of lines of credits or lines of credit. There's credit cards, there's home equity lines of credit, there's personal lines of credit, right? And so what we have is an example here of, let's say it's $85,000 married income, right? So two people bring in the income. So one person maybe makes 40K and one person makes 45K. That's about 5,700 a month. And I think the average household income is around the 78K, 80K mark, which sounds reasonable if you have two people making about 30 to $48,000 a month. And let's just assume that we have a good number of expenses. So if we take a look here, three credit card debts, two loans, and one mortgage. So three cards and three loans, or credit cards and three loans, and about $2,000 expenses. So now we have to do the velocity banking version of this budget, and I'm going to go over that as well. So the first things first, or I'm sorry, let me just say that. First things first, we need to select a line of credit as our main operating account. And let me just kind of go over the requirements for velocity banking. So the very first thing we need is the budget, which we have here. So all your budget, the purpose of it is to figure out where our leaks are and pay off our debt. So as you can see here, all of these, all of this debt is leaks in our cash flow. And then once we pay off more debt, we get more cash flow. It's going to be the snowball effect, and you'll be able to see that on this right side of the screen here. Okay, and if you ever take a look at the amount of savings that we have, it's actually not that much, right? So if you make decent income, $85,000 a year, and you only have about less than thousands left over in savings, you may freak out, right? And I've met plenty of people. Some of you have emailed me with your six-figure situations, and you don't have that much left in the bank, right? It's unfortunate. Now, so we have our budget. We're going to complete it once we do the second part, which is use our line of credit as our main operating account. Now, here's the thing. Let's say in this example, right, we have access to something called a home equity line of credit. And if you don't know what a home equity line of credit is, all it is basically a line of credit, but you're offering your home equity as collateral, right? And what happens when you offer collateral to a lender? Better rates, higher limits. Okay, so that's why home equity lines of credits are awesome. You can also use personal lines of credit that's unsecured, and credit cards in general. There's unsecured ones, or most of them are unsecured, or at least the ones I have are, and there's secured ones in case you're building your credit. Now, in my situation, I have over 240, I think it's $49,000 lines of credit. I got to check again, but I've been recently building my credit, and now I've just been gaining a lot of it. So about $249,000 of lines of credit. But let's just say, hey, we have access to maybe, let's just say, $50,000 home equity line of credit, okay? And usually those interest rates are around 10%, I think. I've seen examples of people say like four or five. Maybe that's like a first position home equity line of credit. I don't know. Like if that's possible, I definitely would trade to 10% for like a 4%. But this is the one, kind of like the one I have right now, 10%. So think of this as like a credit card based on the value of your house, if that's a little bit easier. Okay. So what we're going to do is, here's the thing. We make two assumptions. First of all, the first assumption is that um, our income doesn't change. Now, if you ask the average person, like, hey, this person has all this debt, three credit cards, three loans, and doesn't have that much in savings. How could you help this person with their finance? You know what like 95% of people would say? Oh, just make more money, right? But there comes a certain point where you make more money, the expenses magically increase. Like if this is a $6,700, this is magically going to be $6,064. And so what's important is that we get into higher levels of income, we have to learn how to manage our cash flow, right? So what we're going to do is do velocity banking, same income, and zero savings, right? And so why zero savings? And a lot of people think zero savings, that's insane. I even told my mom that, and she thought I was insane, right? But the basic strategy is we're not going to have any savings because we're going to put our entire cash flow into the line of credit, take out our expenses, and then repeat the process over and over again. That's velocity banking in a nutshell. And you're thinking, is that it? Just that was the 2 seconds of explanation of velocity banking. Yes, that's it. It's really that simple. And maybe because it's so simple, most people won't do it. But most people will turn a 30-year mortgage into a 52-year mortgage. I don't know if you ever heard that statistic, but oh my goodness, most people do not pay off a 30-year loan in 30 years because after the fifth year, they might sell their house or they might refinance, which makes it no extend from a 30-year loan to a 50 something year loan eventually. All right, so now what we're going to do is just calculate our expenses and also calculate our cash flow. So our cash flow is just C2 minus C3. But here's the other thing too. This is the part where we're going to go ahead and create cash flow out of thin air, okay? So how much credit card debt do we have? So this is like 11, and then 11 plus 21 is 32,000, I think. And let me go ahead and verify that. So it goes 5 plus 6 plus 21, 32,000. That's right. So what we're going to do is just do a simple debt transfer to here. So 32,000, okay? And what we're going to do is do 000 because we paid off these debts, right? And then take a look. I didn't even do anything. I didn't even make more money, but we increased our cash flow to from $600 to $1,700. Like, how did I do that? All I did was a simple debt transfer, right? And because we're putting our entire paycheck into the line of credit, this does two things. First thing, it satisfies the minimum monthly payment, so that doesn't really matter. And then number two, it minimizes the interest because, again, when we put our entire paycheck, that lowers the average daily balance. And I'll show you how to calculate that. Okay, so that's month one. So let's go ahead and just pay the sucker off. So what we're going to do is just take the previous month's balance, take the previous month's interest, and minus our cash flow, which is 1715.31. Okay. Now the first month zero, you're not going to have interest because again, interest doesn't come until you get the first statement. But I'm going to show you how that interest is calculated. Okay. So you take the average daily balance. So you just kind of take like the midpoint as an estimate between the last statement month and then the initial balance, and then multiply it by zero point 0.1, which is the interest rate here, right? And then one last thing, you divide by 12 because you get the monthly interest. Okay, so and then now all you got to do is just rinse and repeat over and over again, and you just do Control C, and then you literally just do Control V, and figure out at what point this is red, which means the entire line of credit is paid off. So just to kind of go over the basic strategy, you put your entire paycheck in, right? So this is going to be 32,000 minus 5,700, and then it's going to go back up about $3,984.69. Although it's not exact, right? These are estimates. And then we just pay the interest. It goes down, 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 and after 21 months, right? 21 months. So let's go ahead and write a milestone, right? Milestones. So 21 months, how much debt did we pay off? 32K. Okay. Now, a lot of people kind of freak out about like credit card debt, but to be honest, credit card debt is like the easiest debt to solve with velocity banking. Now, when you get into other loans that eat up your cash flow, but you don't have like a high interest rate, it's a little bit trickier, right? Because some people freak out like, oh my goodness, 10% interest rate and a 3% loan. I'm definitely going to just take a 3% loan without understanding like how loans work, right? And if you don't know how loans work, I suggest that you become familiar with the amortization calculator. Now, given if you just have a 5-year car loan at 6%, some people might freak out. Oh, three grand of interest, right? The thing that you have to be worried about is a 30-year mortgage. Because let me just show you here. So $100,000 at 30 years at 6%, you're paying more in interest than you are in the loan. It's crazy, right? It's like 115% return. And a lot of people don't really think about that. They just, you know what they see? They see this low monthly payment, they see a low interest rate, and they're like, oh, I'm so happy because I got a low interest rate, right? And nowadays, I think, what's the interest rate right now? What, 7%? Let me just do mortgage interest rates in Georgia. Okay, let's take a look. Um, yeah, about 7.5. Oh, gross. So if I put in 7.5 right here, take a look at that. So you're paying, if you get a $100,000 loan, you're paying $150,000 interest at the end of the 30-year loan, assuming that you pay according to how they want you to pay, right? All right, so let me go back here. So, like I said before, auto loans and loans in general are tricky because people see like, oh, high interest rate line of credit, but low interest rate loan. But here's the thing: at this stage, you have two choices, right? You could just directly pay your loan from your savings, which you can do. I mean, that'd be absolutely no problem. But you have to decide: are you going to put your loan, or I'm sorry, your extra savings into one place? Or are you going to split it out? What are you going to do, right? You might just say, "Oh, I'll just pay off this one because this is like the lowest balance, and but the highest interest rate um, at the same time, right?" So you kind of might think that. Well, technically that's the lowest balance, but the lowest balance of the 6% interest rates. But here's what why in general I just don't like to pay loans directly with my savings because a loan is a one-way street, right? And what happens if I put this entire 1700 into this loan? I can't ever get that money back in case I need it, right? That's just how loans work. But with lines of credit, we can definitely do that. Now, one of the things that I actually didn't talk about in this video is this concept called segregation of income, right? And one of the reasons why I love this velocity banking strategy is because it prevents segregation of income. Because what is segregation of income? You get your paycheck, and then your paycheck is split many, many different places, therefore kind of making it ineffective, right? Like that's just how traditional banking works. And the whole point of velocity banking is that you're putting your entire paycheck into one place, thus preventing segregation of income. Okay, so if we have enough cash flow to kind of offset the low interest rates, we're able to still pay off our loans quickly. And again, either strategy is valid. But here, this is a velocity banking video, so we're just going to use velocity banking to pay off our two auto loans because, again, we have a married couple here at 20K at 3%, 22K at 6%, and 200K at 6%. And here's the crazy part: like, there I've seen some loans where they're like 0%. When I was going to California and going through auto dealerships, I was just like driving by, like 0% loans. What's the catch? If there's no catch, I probably pay off that 0% loan last, right? So one of the things I might do is just focus on, paying off this auto loan to first, right? Because it has these are 6% loans, but this is the lower of the 6% loan. So I might just focus on that. Another way that you can figure out which one to pay is using something called the cash flow index formula. So I don't know if you ever heard of that, but all it is just a statement balance. So it's like 20. Actually, let me actually get the current statement balance right now. So we go ahead and calculate that. And let's go to $20,000 at 5 years at 3%, right? And figure out after 21 months, what's the auto loan balance? Let's take a look, right? So 21 months. Where's 21? So this is going to be 13.3K. Okay, so 13.3K. Let me go ahead and copy and paste that. So 13.3K. And let's figure out what this balance is, right, at that time. So 22K at 6%. So 22K at 6%. So 22,000 at 6%. Okay. And then this is at 21 months. So let's go ahead and look for the 21 month. And that would be about 15K, right? 15K. Oh my goodness. All right. So now let's go ahead and copy and paste that, right? All right. So we copy and pasted this. And what about in 20? Well, here's the thing. We're not going to pay this off, but I still want to do a quick demonstration of the cash flow index formula. So let's go ahead and put 200,000 at 30-year mortgage, 30-year, and then at 21 months, oops, 30, not 30%, 6% at 30 years. Okay. So at 21 months, it's going to be 195K. And I always like to show the mortgage schedule because, take a look at the first 2 years. You're paying $22,000 of interest, and you just pay so much less in principal. And if you take a look at the chart, which you should kind of become familiar with, it's kind of disgusting about how much interest you pay, especially in the first whatever 10, 15 years. But let's go back here, 21 months. So it's 195K. So you paid all this money just to chip off 5K to the loan. But, most people don't realize what a trap a mortgage is. Okay, so now let's do the cash flow index formula. So what we're going to do is just do 13,338.13 divided by 359.37. And then we're going to do, so it's just a statement balance divided by the monthly payment. 15,036.43 divided by 452.32. And then this one is 195,603.05 divided by 1200. Okay. Whoops. I didn't even put the equal sign. Okay. So here's what the cash flow index system means. You can almost think of it as like a ranking system. And let me format this a little bit better. Okay. As a ranking system. So what you're going to do is, because think of it like this. It's the amount of payment you get compared to the balance of the loan. So if, let's say I pay this 15 grand off, I get $400 of cash flow back. Whereas if I pay this 195 grand off, I only get $1,200 of cash flow. So that's basically what that means, is that if the higher the number is, you don't get that much cash flow for paying off that loan. That's literally all that means. So it's kind of like a ranking system. So we always want to pay off the lowest one first, okay? Which we'll do. So let's go ahead and pay this one off. And so this is 15 grand and 13 grand. And why don't you know what? If you look at Garrett Gunderson, who made this formula, his explanation, you should pay off anything under 50. That's what he says. Okay. So we could just go ahead and do that. So 15 and 13 at this point. And how much is 1533 plus 15 or 13K plus 15K? And let me go ahead and add that to this, our line of credit here. So plus this, right? And then plus the other auto loan. So why don't we get the cash flow back for both and just use that to kind of pay off the the both cars, right? Because we got a married couple, husband and wife. And I'm going to go ahead and highlight this as so that we know when we just did those debt transfers. And guess what? 0, right? What's our cash flow now? Oh, it's 2,500. Oh my goodness. How do we go from 600 to 2,500 in about, what, less than 2 years? Because it's 21 months, right? So let me go ahead and let's figure out how much time it takes to pay these off. So now our new cash flow is 2,500, right? It's 2,500. So 2,500. And let's go ahead and pay this off and just rinse and repeat, right? So now we're just waiting for this to go to 0. A lot quicker than I thought it would be. So 33 months. So 33 months. 33 months to pay off these two auto loans. So that would be 22 plus, so that would be 42 plus 32, which would be 74K. Oh my goodness, 74K. So if it equals 33 divided by 12, that's less than 3 years to pay off 74K. Mind blown. But here's the thing, in my world, I paid off 58K in 1 year of my mortgage. So mind blown. All right, so so here's the thing. So now the last one is the mortgage, right? So we could just keep making payments because it's a low payment over time. But like I said before, even though, again, the cash flow index number doesn't tell you anything or everything, and let me say that, because if you just, don't overpay with if it's directly with your savings or using the line of credit, it doesn't matter. if you just keep making that low payment, how much interest are they going to make? They're going to make about 115% interest. I just showed you that right now. So you pay 200,000, or you get a $200,000 loan. You pay $231,000 in interest, and it's 431,000 total. So a lot of people, you ever notice in real estate they freak out about like $10,000, $20,000 savings and negotiations with the sellers, but they don't even care about paying the $200,000 or $231,000 to the bank. Ever notice that? Isn't that crazy? But that's how people are, because the banking system conditions us just to view the monthly payment and nothing else. That's all the banking system really trains us to do. And what they're focused on is this number right here, right? They don't really care about this low monthly payment. They're just focused on this number right here because they're in it for the long haul or the big game, whatever you want to call it, right? All right. So now, at this point, after 33 months, what is the what I don't know. I don't know how to say this right. And you know what? I just realized it's probably less than 33 months because we got to make payments. No, actually, I did extinguish the payment. Never mind. Scratch that. I was gonna say if it was like a mortgage where we don't get rid of the entire loan to free up only $1,200 of cash flow, then we still have to make payments as we're paying off our line of credit. So what is the balance after 33 months? Well, let's take a look at that. So 33 months, it's 192. So again, this thing is barely not chipped that much off into the loan. And to kind of, whoopsie. All right, so now it's 192 after 33 months. And at this point, if you have a loan, right, and paying it off doesn't free up that much cash flow, um, you don't want to put this whole thing under a line of credit because you're actually, even though you'll pay it off quicker than normal, there's actually an easier way just to kind of still use the same strategy, prevent the segregation of income, also put your money in one place, make it easy for you to pay off the loan, just by using something called chunking. So what you do is just transfer bits and pieces to the line of credit, and then use your again. This is going to be the very last step, but you're going to use your cash flow to pay it off quickly, and you're making payments every monthly payment, but at the same time you're paying off the line of credit. Okay, so let's go here and let's just assume that we're able to pay off or transfer 192 to five and transfer 5,700 to that line of credit. So what's 192? 192. I'll just put. Hold on a second. 192 60 no 192 875 minus 5,700. That's 187. And one thing I always like to show you is how long does it take to go from 192 to 187? More than a year, right? So it's about like a year and a half. Okay, might even, I don't know if this is like 4 months, a year, and another 4 months. So it'll almost be like 2 years. But let's just go and check out years three and half of year four, how much we're paying in interest. So year three, look, 11 grand in interest and probably 5 grand and 5 grand in interest there. And that's why after a couple of years, like we didn't really make a dent. It's crazy, right? But let me go back here. So how we just saw that it takes like almost 2 years to get from 192 to 187, right? But why don't we just see how quickly we do it just by doing a quick debt transfer? So at this stage, why don't we just do plus 5,700, right? And then look how, and let me actually highlight this. So look how long it took to pay that 5,700 off in 2 months, right? And we're still making, so this is kind of inaccurate because we're still making payments to the mortgage, so it's going to be a little bit more. But so again, we could just do 5,700 again. So what was going to take us 2 years, it just took us 2 months, right? And then I'm going to go ahead and highlight this, and then again another 2 or 3 months. You could probably do it again at this point, but it doesn't really matter. But you can see, like, wow, we're just using our cash flow to pay this off really quickly. And again, we're using the line of credit as a tool this time just to prevent segregation of income. and help us focus all our money in one place, right? So some people freak out, oh, 10% interest rate and 6% loan. Why would you ever use a line of credit for that? Well, it's like, well, think about the behavior of the average American where they turn this 30-year loan into a 52-year loan because they either refinance or resell their home. And one of the reasons they do that is because they love low monthly payments, and that's where the bank wants you at, right? And they want you to focus on the interest rate. So if you have a low monthly payment and a decent interest rate, and then you're able to refinance, the bank probably wants you at the highest interest rate. But if you're able to refinance, all you did is just restart the loan. Um, and again, there's a right time and place for refinancing, but I just in general want to pay off my mortgage in like 3 to 7 years rather than like 37 years or 52 years, right? And if you don't know what I mean by that, just do this exercise over and over again and realize most people just kind of get screwed with mortgages because they don't realize this $200,000 loan after 30 years is going to be a $431,000 loan, right? They just don't realize that. That's the whole point of this. Okay, so now let's just restart from where we were. So we're at 192,000. I think that's where we're at, right? After 33 months. And luckily, we have this cheat sheet calculator to do all this. So, I talk about this calculator, which is fantastic, in many of my videos because this is where I actually first learned velocity banking from. I don't know if you ever heard of an educational company called Renatus, but I'm a student of Renatus and I learned it from there. And I remember I saw this calculator. I was like, wow, it's really cool. I could just estimate the payoff and you just got to fill in the numbers correctly. So just, what's the exact number? It's 1199.1. So let's go ahead and put that. 1191.1. And then you only have to just really transfer your, uh, what's it called? Your payment amount or your monthly income. Okay, and then just fill it in, and then you're good. And so now here it's about what's her expenses, everything but the loan. So it's only $2,000. So let's go ahead and put this income in, and I think living expenses 2,000. How long is it going to take us to pay it off? 5.1 years. Oh my goodness, how easy was that? So 5.1 years, right? So 5.1. And what we do is just we combine these two numbers. So let's just go ahead and combine this. So 2.75 plus 5.1, and that's 7.85 years. So 7.85 years to pay off 274K. Done. Bam. Debt free in less than 8 years, right? And not that bad, right? So paid off 2 car loans and a house under 8 years, and $32,000 in credit card debt. Pretty amazing, right? Or no, maybe not. Maybe you're just like unimpressed. You ever see that? Remember that gymnast who had that unimpressed face? Maybe that's you. But maybe you have a better strategy you want to introduce to me. I don't know. Or maybe this is all nonsense and I don't know what I'm talking about, even though I've done hundreds of videos on this and I've done it myself. All right. So, well, all right. That's it for today. Welcome to Crane Atlanta Mentorship. And welcome to Velocity Banking Friday Nightclub. Right, we got a bouncer here. The only way you can enter this nightclub is if you have three things: you need a laptop, a spreadsheet, and a line of credit. And if you don't have those things, and also $10,000 entry fee, you don't get it. No, I'm just kidding. If you're interested in joining our group, go ahead and click the Google form link below and fill out your information, and we'll get on a one-on-one Zoom call. We could learn about lots of things: velocity banking, financial literacy, real estate investing, lots of stuff. And if you want to talk about it, we can also, we'll talk about that in the call. All right, everybody, have a great day, and we will speak next time.